Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended July 11th, 2018. That's a Wednesday time period. And we saw about $19.3 billion enter the conventional fund business. It was the second week in three that we saw net inflows into the conventional fund business. This is primarily just funds, ex-ETFs. We'll talk about ETFs later on, but kind of giving an overview of the fund business as it is. And it was kind of a strange week. Basically, we saw really good returns. I think the NASDAQ was up like 2.3%, and the S&P was up, and just about everything was up. But investors remained really cautious. This is, again, we're entering the second quarter earnings season, and we expect it to be really good. But President Trump and the trade war rhetoric that's going on has really put people on a stopping block. They're not necessarily doing mass redemptions or anything like that. They're just putting money in and like kind of sitting on it. So really, of that $19.3 billion, most of it went into money market funds. We'll talk a little bit more on the detail of that. In fact, why don't we turn to the macro groups right away, and you can take a look at the big snapshot of what went on in flows this week. If we take a look at equity funds, basically we saw outflows about $1.5 billion. Again, we had a really good week in the market, but $1.5 billion flowed out of equity funds. Taxable bond funds lost about $1.2 billion. And then we see that muni bond funds took in $628 million, and money market funds took in the lion's share, $21.3 billion. Net new money coming to that group, again, just sitting on the sidelines. Well, let's see how it panned out for each of the groups. Let's first take a look at our equity macro group. This group basically saw a 1.66% return, second consecutive week. We've seen pretty strong returns, but again, $1.5 billion in outflows. It's the third consecutive week we've seen outflows. And how it broke out, domestic equity funds saw about $902 million in outflows. It's the eighth consecutive week they've seen money leave their coffers. And then as we take a look at the, by the way, 1.99% return, so like a little bit of a head scratcher. And then on the non-domestic side, we saw about $555 million in outflows. Third consecutive week they've seen outflows. But it's the second consecutive week they've actually had plus side return as well, but only about half of what we did in the U.S., about 0.98%. Now, if we take a look at like the large cap, small cap, continuum, we basically saw most of the flows come out of large cap funds, which has been the trend for years now, it seems. $1.1 billion actually went out of that group. And then we saw that on the global international side. We saw global equity funds lose about 743, and international equity funds took in a very small amount of money. But so really it has been a tale of two cities in the idea that we've seen outflows occur in both groups, right, domestic and non-domestic, but really we're seeing just a minor amount, usually about half the amount, go out of the international equity funds. A couple of weeks that hasn't been true, but certainly people are still keeping the pedal to the metal in many cases in international and avoiding that global equity group. So let's go ahead and take a look at the ETF universe on the equity side as well. For the sixth consecutive week, we've seen outflows, $387 million this time. Schwab U.S. long-term ETF, or I'm sorry, large cap ETF saw the largest inflows, about $902 million. Then we saw the healthcare select shares spider funds taking about $531 million. And if you look down at the bottom, we see the First Trust technology Alpha Dex ETF lose about 588, and then at the very bottom we saw SPY, the Spider S&P 500, lose about $554 million. So not a lot to talk about there, but certainly we saw that there were some net inflows on the ETF side versus some of the big outflows we've seen on the open-end side. Again, both are experienced net outflows, but again, only $387 million for ETFs. Let's go ahead and take a look at our fixed income universe, see what happened there. Fixed income funds, and this is the open-end universe, for the third consecutive weeks, lost money. About $1.2 billion flew out of those coffers. Second consecutive week, they've had plus side returns, 0.44% this most previous week that just ended. The big attractors of money were government treasury funds. Again, people being a little bit more cautious. They saw about $280 million coming to their coffers, and then government mortgage funds saw about $58 million. On the bottom side of this, we saw corporate investment grade debt funds lose about $619, and corporate high yield funds lose about $240 million. Well, let's go ahead and turn our attention to the ETF side of the fixed income universe and see what happened there. Basically, we saw that for the fifth consecutive week, we saw inflows, $4.5 billion in inflows. Basically, though, they got a little bit more aggressive looking for yield. We saw that the iShares iBox dollar high yield corporate ETF took in about $1.6 billion, and then we saw the iShares iBox investment grade corporate debt taking about $690 million. And at the bottom of the barrel, we saw, and this makes sense considering we did have the Fed come out with his minutes and reconfirm that they're going to have 2 more rate hikes, or at least that's the plan so far this year as well. We saw that the iShares 20 plus Treasury bond ETF lost about $318 million. Well, let's go ahead now and take a look at the muni bond funds side. At the top of this segment, I basically told you they had inflows. This week we saw it $628 million. It's the 5th week and 6th that they've taken in net new money. And in the 4th consecutive week, they've had plus side returns this time, this week, to the plus side tune of 0.13%. Again, not a lot to write home about, but certainly we're seeing flows and performance in this group as well. High yield munis took in the lion's share, taking in $323 million, and then in the other investment grades actually made up kind of the rest of it. These single states were actually very flat. Let's go ahead now and take a look at our money market funds. This is where all the money went, and again, people are sitting on the sidelines just waiting. First of all, I think for the earnings season to get caught up and get running a little bit, but maybe see some returns come back in, and then we'll probably see some money flow back into the equity funds again. But certainly, they're concerned about the trade concerns, and how we saw this is for the second week in 3, we saw net inflows $21.3 billion this week. Taxable money market funds took in $21.5 billion, and how it broke out was institutional investors padded the coffers about $19.3 billion, while retail investors put about $2.2 billion back to work in the money market funds. And at the bottom end of this, basically we see that the tax-exempt money market funds suffered a slight outflow, about $150 million in outflows for that. Well, that's really it for me this week. You know, obviously I'm going to keep my eyes on what's going on with the beginning of the second quarter earnings season. Actually, we've had a couple already reported today on Friday, and the numbers are not looking all that bad. In fact, we're still having earnings surprises, so I think that'll be good. And also, we're going to have to keep a really close eye on the trade rhetoric that's been going on with the President Trump actually coming out and raising, I think it was another $300 billion of tariffs that they're going to do to Chinese goods. Things are getting a little bit more heated, a little bit more serious, and so we'll have to keep an eye on that. If I haven't done a deep enough dive for you, you can go to our website, www.uslipperfundflows.com. If not, join us next week when one of our analysts will talk about the flows trends of the week. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.